So welcome everyone. We are very happy to have you. I'm Anthony Volin, the owner of The Collective. We have Tim Tobish, fabulous agent, and Cindy Lee, it's her birthday. So happy birthday, Miss Cindy. And we have Gail, who's joining us on Zoom, also an agent at The Collective, and Marty Carey from Arcstone, who is my most trusted lender out there in the lender universe. So we're very lucky to have him join us today too. So at The Collective, our mission is really to help people build wealth through real estate and to help them to get on that path, to figure out what that next step is for them. And this seminar, we do it quite often because we think it's a really important step of trying to figure out how to get on that path. There's so many myths out there, like, you have to have 20% down to purchase a home, or unless you have cash, you'll never get in on this market, that stop a lot of people from getting on that path to creating wealth. So we want to address some of those myths and help you see a little clearer on what are some of the things you could do next to find out when you'll be able to get on that path. Maybe it's tomorrow, maybe it's in a year, 2 years from now, but at least this is going to be the first step for you to find out and to get on. We're constantly getting real webinars on all different types of topics. So I encourage you to check out our YouTube page at The Collective Realty. So if you're on YouTube, just go to The Collective Realty and we have lots of education that's on there. We have a couple seminars that are coming up. Yearly, we do this one. It's one of my favorites. Some of the best economists out there have put together some really great slides for us, giving us a 2022 forecast for what the real estate market will look like next year in 2022. So it's always a hot topic. What's going on with the market? What's going to happen next year? Well, we have all that data put together, and we're going to be presenting that in about a 45-minute presentation on December 1st at 11 o'clock. So if you're registered for this, you'll get an email reminding you of that one. If you're interested, if you can't make it, don't worry. We post everything on our YouTube page. You could watch it at your leisure anytime you'd like. We also have kind of an interesting class, a little forward-thinking, but crypto and real estate coming up on September 6th. And that's all about how you can use crypto to purchase real estate and what's happening in that world. So that'll be on December 16th at 2 p.m. Also, if you're interested in investing in real estate, we have an amazing meetup with fabulous speakers, and we have presentations that are very different every month. If you go to lamultifamilymeetup.com, you can join the group and you'll get emails every time that we have an event there. As well as, look, all of our events are always on our website. So you can go to The Collective Realty and find everything there and join. But I just wanted to make it really clear from the beginning that we're here to educate you. This is our passion of why we're here, just to help you learn as much as we can teach you, to help you get on that path to building wealth and continuing to build wealth after you're a homeowner. So again, thank you guys so much for joining us. We have, like I said, we're going to talk about a lot of the myths that are out there and address them. Marty, one of our lenders, will be speaking. We have a great agent panel that you see here with me, and including Yale as well. And Yale's going to be joining us as well. So we have some great stuff to discuss today. We will be done by 5 o'clock. And so we'll be here for about an hour, and we'll have time at the end for any questions. If you have any questions during the conversation that we're doing, please raise your hand or type it in the chat, and hopefully we'll be able to get to that during our conversation today. If not, we'll absolutely get to it once our formal presentation is done and address anybody's personal questions at that point. So I guess, why don't we start with, if you don't mind, in the chat function, just so we can get used to using that, type in, why you're here today, why, you can also put in, why do you think it's more important to own a property versus renting a property? What do you hope to learn or get out of today? And then we're going to kind of talk about why homeownership is such an important part of building wealth in long term. So anything you want to write in there, feel free to go ahead and start typing that stuff in. And I guess this will be kind of an open-ended question for any of you guys out there. So one of us says, I want to be able to tell buyers why they needed agents. That's why Lori Pond is here. She's an agent. Okay, Lori, sounds good. But Marty is one of the smartest financial people that I know. And I look up to you and I trust you with your advice. Like, what are some of the reasons why you would tell someone that it's so important to own a property and to own versus rent?
So, I mean, there's a lot of good reasons why to own. I mean, when you're renting a place, you're basically wasting your money. You're just giving it to somebody else. You're making somebody else wealthy. You want to be in that position yourself. Obviously, the goal would be is to be a landlord and have somebody else pay your mortgage. But overall, I think having your own home in itself is a great place to start. And that's going to be where you're going to be not worried about being evicted, not worried about, what kind of changes you can do to the property. You can do whatever you want to do to your own property. It's a lot of freedom that's given. And plus, on top of it all, there's tons of tax benefits as well that you would have from, a lot of us pay a lot of taxes when we earn when we work really hard. And so in order to get those tax benefits, you'd have to own a place and you could deduct the interest off of your property, off of your taxes.
Yeah, I mean, let's touch on that for a minute. I hear from a lot of people that say, oh, I heard that something about SALT and that you can't deduct mortgage, interest anymore. And it's not as good as the time to buy a home as it used to be. How would you address that? For most of us, I tell them it's just the same. You can still deduct it.
There were some changes that happened that made it a little bit less, that restricted it a little bit. So the max you could deduct is capped now. I'm obviously not able to give you tax advice on here because of licensing laws and whatnot. But it is, if you look it up, generally the tax benefits are capped at $750,000 for interest now, and your property taxes are capped at $10,000 annually. But that's still a lot of numbers. You still can get into a condo, a home. These are huge numbers for the country. Obviously it doesn't apply in Southern California very much just because of the fact that prices are so expensive, but still like the $750,000 of interest deductions is huge, obviously. Yeah. So.
And you mentioned freedom, right? Like that to me, like really resonated with me when I decided to first purchase a home. With rent, even though you might live in a place that has rent control. A lot of California does, right? But even with rent control, your payments that you pay every month are going to go up. When you have a mortgage, they don't. They're staying the same. You have that, and eventually, for most cases in 30 years, they just disappear. They're gone. You're just paying your property taxes, but that mortgage payment is gone. So that creates a lot of freedom at that level to be able to get to that point. And there's some stats that they've read that throughout the country, so this isn't for LA, but this is through the country, when they measured the wealth of people who make a certain income level, who owned a property and who rent, and after 10 years, what their wealth differential was. Someone who is renting a property, the amount of wealth that they have is close to $2,000. That's what they're worth, about $2,000. And someone who owns a property, their wealth after about 10 years is about $200,000. That's kind of an average for the country. So can you imagine in Los Angeles what that would mean? It's definitely going to be more than that. So, if you're getting on the path to wealth, and for me, an important word is like generational wealth. If you're the first person who's able to purchase in your family, in your generation, when you have that property and you're able to inherit it or pass it on to a family member or a charity, it creates such a powerful, amount of wealth down the road that if you were renting forever, you wouldn't be able to do. So, for so many reasons, it's so important. Do you get any other thing that we missed?
That's, I think, the most important thing. I think most people don't recognize that it's really, really hard to save, especially when you are renting. When you buy a home, especially the last 12 years, people have made hundreds and thousands of dollars. How could you save, $500,000, $600,000, $700,000? That's nearly impossible to save that much in a lifetime, obviously, unless you're doing some really good investing. But, obviously real estate has created that, and it does always, it goes down, but it always goes back up as well. So it's not a one-way trend ever.
You're right. It is difficult to save for whether you own a home or whether you're a renter, it can be hard to save. I mean, especially now with inflation and things going up, it's more expensive. But when you own a property, part of your mortgage payment that you're making, it's like putting part of that payment into a savings account. It's a force. It forces you to put that money into a savings account every year. The amount that you're paying off of the principal is that savings. You will get 100% of that money back. That's, you're paying off your principal later. So it's a forced savings account. And when a lender told me that at one point, it's like, that really opened my eyes too, to say like, every dollar you're spending on a mortgage is a positive dollar. You're either going to get it back. Some money's appreciating, which is like magic money that you're going to get down the road, or you're going to get tax deduction. So pretty much every dollar is good. When you are renting, every dollar is burned.
It's an expense.
It's an expense. It's burned. It's a negative dollar.
Yeah.
So owning versus renting is so important. And a lot of the times it's just kind of wrapping your head around what it is that you're able to afford, what you can do. And there's a level out there for a lot of us that we can start and get into something. And we'll kind of get into that in just a minute. But let's talk about like getting qualified, right? And like how can we get qualified for a loan? What is it really going to take? We have an amazing, it's about a 30-minute video on our YouTube page, just about how to improve your credit and everything that makes up credit, because that is an important part of purchasing a home. So if you're interested about everything you need to know about credit, check that out. But let's go through some of the basics right now. So what makes up your credit score? Are student loans a part of it? Like what? Yeah.
Yeah. So, I mean, really quickly, I'll share my screen really quick with all of you guys. What makes up your credit score is, let me move this out of here, is going to be a very small, a quick presentation on this is going to be your payment history, making sure that you're making your payments back on a timely basis. So whatever debt you get out, make sure you pay it back on time. That is the highest weighted reason, the reason why your scores could go higher or lower. Second is how much you owe on your credit cards, or however much like unsecured debt you have. So credit cards are obviously going to be the ones that are going to have like a revolving balances, so you could actually charge more, pay off more. So that is going to be the next most important piece. And what you want to do on those is that the rule of thumb is you do not want to borrow more than 30% of what the line is. So if you have a $10,000 credit card or limit credit card, you do not want to borrow more than $3,000 on that credit card. If you borrow more, it's going to start affecting your credit scores to get lower. Doesn't mean that it can't go back up. Once you pay it back down, it does go back up, obviously. So, but that is a continual check that the credit reporting agencies do to make sure that your balances are not exceeding, because you become a risk at that point. You may be borrowing too much money on your credit cards and you can go file bankruptcy, or you're mismanaging your money. So that's the reason why they do that. The other one is length of credit. The longer you've had your credit, the better. So we will always advise you to never close an account out. So if you have a good credit card or whatever it may be, and you got upset with them one day and you said, close out my credit card, I don't want your stuff, do not ever do that. Do not be hasty. Just keep the credit card open, because the longer your credit is seasoned, the better your credit scores will be. And then the other two are just very basic. You want to have a mix of credit. You want to have the 10% of it is going to be based off of your mix. So like if you have student loans, credit cards, car loans, the variations, that is the least amount of impact, but you do want to have a variation of credit. You do not want to not have.
How many lines of credit should you have? Should you have just one credit card, just one card? Like what, is there an ideal amount, or does it matter?
So yeah, so traditionally back in the day when we were actually doing manual underwriting, it used to be where you need to have at least 3 credit cards, or 3 trade lines, I should say, a car loan, a credit card, or a student loan, or a mortgage, whatever it may be, seasoned for 24 months, minimum of 24 months, 3 trade lines. And that's still valid to this day, but a lot of automated underwriting systems have, making decisions differently, but the rule of thumb is have 3 trade lines.
So what are trade lines again? We all know credit cards.
Credit cards.
What else?
It could be a car, it could be a student loan, which we all have these days, but they're not very heavily weighted, but they're there. And then you could get things like, home equity line of credit. That's rated differently if you have a home already, or if you don't have a home.
How about my cell
Obviously,
phone bill?
that does not actually, so you could self-report these. See, there's a new thing that Experian has come up with, that you could self-report your cell
Oof,
phone
yeah.
bill and things of that nature. I don't want you to be aware of that, but that's really not that helpful. I wouldn't go about doing that.
So utility bills, no, but okay,
Yeah. I
great.
wouldn't add those. I've looked at these and they haven't really boosted the scores too much. So I would probably eliminate those things off your credit. But yeah, a lot of you guys think, oh my God, when you're applying for a loan, do I have to give you guys my utility bills? Do I have to, how much my cell phone bill is? You do not have to provide any of that information to us. So
Okay, awesome. And as far as scores, what's an ideal credit score to get the best rate?
that's right here, basically. So credit scores are varying over here. So they go from 300 to 850, the range. 300 to 579 is considered poor. Generally, you want to be above 580. That's generally where good lending starts, which in this case would be FHA. And then anything over 620 will open up a lot more doors as far as options of loans. That's where the conventional loans come into play as well. And then anything over 700 is going to be excellent. You really want to strive over 700. That's really the goal, is to be there. And if you guys have any questions, you don't understand credit, that's what I'm here for. I'll advise you on that. So, it's always a good idea to look at your credit through a vendor such as us and make sure that you know what it is, and not follow Credit Karma or the Experian and things of that nature that are reported for you guys on your free websites, basically. So we get different scores than actual consumers do. So make sure you check your credit scores through a vendor and have them advise you, a trusted vendor, obviously, and have them advise you how to maintain or increase your credit scores, because there are tricks that we know that could increase your credit scores.
Awesome. Okay, sounds good. So there are programs, in the fair category that you still can get a loan for. And hey, if you have a credit score that's not great right now and you really want to get into a property, you can do it. And as your credit improves, refinance later down the road.
Absolutely.
So let's talk about some loan payment programs. Like we said, the biggest myth that I hear why people say, I cannot purchase a home because there's no way I'm going to be able to save up 20% to buy a property. If I'm buying a $500,000 condo, save $100,000, there's no way I can do that. To buy $1 million house and save 200,000, there's no way. But is that true? Are there other programs and possibilities to get into properties? Marty,
Absolutely.
you
Yes.
want
So
to
there's,
keep sharing your screen, or are you?
oh, I think I'm going to stop the sharing that
Okay,
screen
cool.
really quick. So yeah, so there are multiple different types of loan programs. Nowadays it's become a lot more available for people to be able to buy homes with no money down. So we have programs such as, if you're a professional in the medical industry, such as a doctor, a veterinarian, or a pharmacist, they can get a loan. They can purchase a home up to $1.5 million with zero down. Also, there are programs that are for more of our lower income individuals that could put zero down as well. And these are questions you want to ask us to see if you fit within those boxes.
And vets,
Then,
right?
I'm sorry?
And vets. So we have like three different
Oh,
groups of people now who can purchase with 0% down.
yes. Veterans can get loans at 0% down as well, too, which is, I think, one of the best things that the Veterans Administration has done. To get these people, and they're very highly performing loans. So, people actually do make their mortgage payments back, which is wonderful. The other programs is you could go into properties with as little as 3% down as well, and can be in a conventional. You don't have to have a medical professional, degree. You don't have to be a vet, or you don't have to have low income restrictions either. So you could be at 3% down, and you could buy a loan. You could get a loan with those capacities as well. So don't hold yourself back thinking that you have to save 5, 10, 20% down, because there's so many different options out there.
Awesome, thank you. Also, we hear a lot of people talking about house hacking, and if you really want to build wealth the fastest, you should buy a duplex or a fourplex and live in a unit and rent out the rest. Do you have to have 20% down to do something like that?
Mm. Yeah, I mean, even up to fourplexes, you could get as little as 3.5% down with FHA loans. So it's I love the duplexes, triplexes, fourplexes. They're great properties. So you can get them at a much lower down payment as well too. Traditional financing allows for 10% down. But FHA allows for 3.5% down. But there are, these are things that you want to talk to us about and make sure that the property type fits those boxes as well too of FHA. But with FHA, you could get a up to $1.5 million loan with 3.5% down, which is amazing. I mean, it fits all of California and or Los Angeles requirements too, I would say. You should be able to find something for that range.
Yeah, it's pretty amazing. There's a lot more options out there than I think people realize. So, part of our goal today is just to open your eyes to know that there are a lot of options, and getting on the path to building wealth through real estate may be an option. So let's move on to the next section. Besides your mortgage payment, there are some other costs when you become a homeowner. We always hear PITI. What does that mean? So what are some of the other costs that people should be aware of, and the costs that you bring up and help them to
Sure.
calculate into their
Yeah.
total payment?
So when you buy a home, you're going to borrow money from us, and you're going to that mortgage comprises of your payment comprises of two pieces, an interest piece and then a principal piece. So our goal is to have you pay off that mortgage within that 30-year period if you get a 30-year loan. So a principal portion goes towards paying down your balance every month, and then the interest portion goes towards us basically for giving you the money. And interest rates are obviously very low, so that interest portion is very, the payments are become much lower these days. So with that said, PI stands for principal and interest. But then there's two other pieces to that. When you buy a home, now all of a sudden you have property taxes. In California, they're limited. There's a set amount of property tax that you pay on a monthly basis. And what we do is we break that down on a monthly basis and give you a set amount that you have to pay with your payments. You're not required to do that, but it's something that I advise people, especially if they're first-time home buyers, to budget that in their payments. So that way, when they go, to pay their property taxes and they go into their savings account, they go, what do you mean I've got to pay a $12,000 bill? So this way, what we do is we break it down on a monthly basis, and we make you pay a portion of your property taxes to us, and then we settle it with the county assessor's office
So,
on a yearly basis.
so
Sorry, go ahead.
technically, you need to pay property taxes twice a year. Every 6 months you have to pay property taxes. But the way that most people do it, and the way I do it, is like Marty said. You set up an account and you're paying your mortgage and your interest and your property taxes once a month, and it's divided. So you have an even budget, and you're not like, oh my gosh, every 6 months I have an extra expense. So thanks for bringing that
It's
up.
very
That's a
daunting.
smart way
And
to
then
do
there's
it.
one more thing you got to have is insurance on the property as well too. And it's not very expensive. I think people sometimes get scared with that. And insurance on a house of, maybe a 3-bedroom, 2-bath house with maybe a 2,000 square foot would probably be about $1,500 annually. So we'll take that $1,500 and divide it by 12, and you make that in your monthly mortgage payments as well. So that's, PITI stands for principal, interest, tax, and insurance. So that's what you want to ask any lender that you speak with. What is your PITI? Because that is what you want to know what your full payments are.
Perfect. Okay. Can you just give us a couple ideas? Like if someone was to buy $700,000 condo, I mean, and that could be in West Hollywood, a 2-bedroom condo, it could be a 3-bedroom condo somewhere, depending on what it is. But say that, and they're going to put 10% down, like what would a payment be for something like that?
Yeah, I created that comparison for you as well. So let me share that with you. So if you guys could see my screen, I created one for a $700,000. The first column, that is option number one, is $700,000 purchase price with 10% down, borrowing $630,000, which the rates are currently at about 2.875 for a 30-year fixed loan. So when you put 10% down, you're going to have this thing called mortgage insurance. So in the United States, when you borrow more than 80% of the value of the property, you're going to have a mortgage insurance that is purchased by the lender, and you pay for it on a monthly basis. That basically insures us for the deficiency of the down payment. Let's say if you put 10% down, it insures us for that 10% that you didn't put down to make it an 80% loan to value ratio. So with that said, you're going to have this mortgage insurance that you pay on a monthly basis as well, on top of your regular insurance, which is for fire, flood, things of that nature that you have to get. This mortgage insurance is just for the lender. And so with that said, your payments, your principal and interest payment will be $2,613.82. I assumed that this was going to be a condo, just to letting you guys know, at a $700,000 purchase price. So condo insurance is going to be far less than a home insurance because there's not that much other things that they need to cover. So it's about $50 a month. Your property taxes are going to be about $729 on a monthly basis. Your mortgage insurance will be about $110 on a monthly basis. That is something that will go away when you build 10% more equity on your property. So let's say you pay down the balance by 10%, and all of a sudden your loan to value ratio becomes 80%, that $110 goes away. That's not going to stay forever on your mortgage payments, letting you know that. So your payments can easily drop by $110 on a monthly basis. And then I put a $300 homeowner's insurance. So altogether about $3,800 is what I came up with on your $700,000 purchase, with 10% down, which is $70,000 in this case.
Got it. And I mean, I remember when that number just a couple of years ago used to be about what just the mortgage and interest was, not including your taxes. So with our interest rates right now, it's amazing. Okay, let's briefly talk about the next two, and then we gotta move on to the next section. But if you want to get more details on this, Marty's the person to talk to. Also, you can go to our website for a general mortgage calculator at the Collective Realty and put in purchase price amount, interest rate percentage. I say use 3% just to kind of as an average, and what your down payment is, and it'll calculate a general idea of what you can get. If you want these exact numbers, then Marty's your go-to guy. So,
and I'll send this over to you guys so you guys could share it with the audience as well too, the presentation. So the next one is basically a $1.1 million house purchase with 20% down. That would make your loan amount $880. Notice that you're not going to have mortgage insurance in this case because you're putting 20% down. With this being said, your payments all in would be about $4,900, $4,955. And the reason why the rate is a little bit higher because it's a jumbo loan, and we'll talk about that when you guys call me. I know we want to have more information. And then I put one more option here for you for an FHA with 3.5% down. So let's say you find a condo or duplex or whatever it may be for $800,000 with 3.5% down. With this, your payments would be about $4,728. Just giving you a quick rundown of what the payments would look like. And we could send this all over to you guys so you get to share it with the group as well.
Awesome. So single family home, that's amazing. 800,000 with only 3.5% down. Okay. Got it. All right.
I'll stop sharing.
Thank you, Marty. Marshall, can you post in, or Marty, if you want to type in all your contact info in the chat, that would be awesome. So everyone has all your info. Now we're going to move to our next section. And we'll go to Yale. So Yale, you know, how early do you usually ask your clients to kind of get qualified? Like, what's that process look like? Tell us a little bit about that, because, you know, and how do you deal with your clients when you find out, like, okay, we're qualified for 800,000. What do you do next? How do you bring that into reality? Yeah.
Definitely. Yeah. So thanks so much for having me. One thing to kind of touch on that Marty just spoke about was the fact, as you guys saw some of the numbers based on off different purchase prices, but a lot of times the rent that we pay is equal to, sometimes even greater than what a mortgage would be, even if we had 3.5% down, or you qualify for a loan with 0% down. Let's say you have a roommate that helps pay towards the rent. So I think that's something that's really important to focus on. Also to kind of be proactive versus reactive. So kind of what you're talking about, Anthony, with getting pre-approved. So important to talk to someone like Marty or anybody that you know that's bought a house. You can ask them who they worked with. The reason why it's important to work with someone, though, that you can be in touch with instead of just walking into a bank and talking to the loan officer that's available, is that if you are on a shopping spree on the weekend and you're with your agent and you do want to make an offer and you want to have your offer letter and your lender letter available when you do make the offer, you have access to a lender like Marty so that you can contact them. A lot of times I've written offers on a Saturday or Sunday, and we want a lender letter, but you want it customized to that property. So let's say you are approved up to 800,000, but you want to buy a house that is listed for 700,000. You want to offer 650. Well, you don't want the letter to say you're approved up to 800, because then the sellers will see that and be like, well, why are they offering 50,000 less than what we're asking for? So that's one reason why I think it's really important to have a good relationship with a lender like Marty. Also, just kind of being proactive versus reactive. So even if you're not ready right now, talk to a lender, figure out exactly what they need. Maybe you haven't filed your taxes yet, and they will tell you, well, we actually need your 2020 taxes, you have filed for an extension. So there's a lot of things that you can do to kind of clean up before you actually do get pre-approved, and people can, you know, give you advice as we all know, but until you actually talk to a lender, you really won't get kind of the big picture. So kind of what I always tell my clients is, let's be realistic. So if you want to drive around and look at open houses, or you want me to create an MLS search for you, we really need to know what that price range is. So if you know for sure I want 3 bedrooms, 2 baths, I need a garage, I want a pool, all of those things are important because you need to be realistic. So let's say you're driving around the weekends looking at $1 million houses, but really you can only afford a 1-bedroom condo that's around 400,000, which is totally fine. But we just have to be realistic. I've had clients in the past that they have a lot of money in the bank, but maybe they work in an industry where they're not reporting all of their income. And so you will talk to a lender and they'll be like, you need to start reporting your income to make sure that you're paying taxes on the money, you know, that you are actually bringing in. Of course, Marty would tell you bank statements, all those things that he would need you know, to start the process. So I think really overall, it's so important to be realistic, know how much you're pre-approved for, and really start cleaning up what you need to clean up before you can start today, even if you're not ready to buy until next year or in 2 or 3 years. And as we know, 30 years goes quick, and LA is always going to be LA. We have the Olympics in 2028. And we always have the weather. So a lot of people are saying, well, we're moving out of LA, but that's maybe a good thing because it's going to give more people an opportunity to buy a home.
All right, thank you, Gail. A couple of things you mentioned, which are awesome. I mean, really, at least I would say a year ahead of time, right? Start talking to a lender and start planning what's going on so you understand what your price range is. In LA, a lot of people have their own businesses and they're not W-2 employees. So Marty has tons of programs that people can get qualified for. If they write off a lot of expenses and have a lower income, there's ways to still purchase a house through that. Also, I wanted to give one more plug to Marty because he's not a bank, right? He's not like going into Wells Fargo or Bank of America. He's a mortgage banker. So he has the most options out there, the best rates, and the easiest way to qualify. All of the big banks have a lot of I don't know, overlays, right? They use overlays, just more restrictions on how to qualify for a loan. So it's a little bit more difficult. So somebody like Marty is really why we trust in him and we refer our clients to him because it's the easiest way to get the loan done and cause you the least amount of headache and the best opportunity to actually be able to purchase something. We've had so many people who've gone to another bank and say, we cannot qualify for a loan. And I said, well, let's try one more time. Let's try with Marty. And they're like, oh my goodness, I could actually do this or that now. So not every lender is created equal. Just know that. Okay, let's go into Tim. So right now, it's a competitive market. It's still a seller's market, not as crazy as it was this summer, which is good for buyers, but it's still a competitive market. And with the competitive market, we've been seeing a lot of buyers looking at houses and saying, you know what, I'm just going to go directly to the listing agent and have them represent me to purchase the home because, you know, maybe they'll give me a better deal and I'm working with them and it's going to be an easier situation for me to get a deal. But we know that's not always true. And, why should a buyer not go directly to the listing agent and consider using a buyer's agent that is fully representing them?
I would go put that a little bit more strongly and say that's rarely, if ever, a good idea. I mean, we as real estate agents, we have what's called a fiduciary responsibility to our clients. And briefly, without getting into it, it basically means that your money is more important to us than our money. We ethically have a duty to make sure that your needs are met and your wealth is built. The listing agent, let's just say you go into an open house, and the listing agent says, hey, sure, make me an offer. That listing agent has a fiduciary responsibility to the seller, not to you. So through the entire step of the process, you're negotiating your request for repairs, you're getting your offer accepted, all that, he or she is going to be prioritizing the seller's needs over you. It's legally and fiduciary, that's their responsibility.
There's a contract that's signed.
Yeah,
right?
it's a contract.
That says, I as a listing agent must represent the seller before the buyer.
Exactly. So you're going to lose out. So you can and will lose money, and money will be left on the table. So what's the solution? So what do you do when you're at that open house? And do I go with a Zillow lender who's coming up on this? And that's our Zillow agent. You don't know that person. It's possible they're good. You have no idea. Just like what Yael was saying, the best thing to do is to get involved with a buyer's agent before you really start the process. The buyer's agent will basically help you focus and narrow your search. We're not going to find you properties. It's not the old days where our parents would call and say, hey, agent, go find me properties. There's so many resources for everybody online. But what we can do is help to focus and narrow your search and save you a hell of a lot of time in running around to set up appointments and all that. But most importantly, we match your needs and budget with the realities of the marketplace, because we're in that marketplace every day. We're looking at it every day, especially in our areas of expertise. So all of that helps. And at that point, we've got your back during the escrow process to make sure that happens. We generally like to work with lenders. We know if you provide us with a lender, we will get to know them. There's just so many reasons to use a buyer's agent rather than go direct to a listing agent or use somebody offline that you don't know. And because not all buyer's agents are created equal. Finally, there's really there's a cost, but it's indirect. So the commission comes out of the seller's commission. So you're not making any direct payments for a buyer's agent. But because of all this, there's kind of really no good reason not to use a buyer's agent and try to do it yourself.
Yeah, it's a must do. And in the past, it's always been the case, but for whatever reason right now, we're just seeing more people going directly to the listing agent. And I think that they just don't understand that agent can't fully represent them. So using a buyer agent is super important. Yeah. Yeah,
and we provide a hell of a lot more service than just opening doors. We don't just show up and open doors. Cindy's going to talk in a minute. The most important thing that we do, and Cindy and I do together as we work as a team, is to get your offer accepted in this competitive market. But she's going to talk about that in a minute.
Yeah. Okay. First, just a couple quick little tidbits. So, now that you've got qualified, you have a buyer's agent. Now you get to go out and go shopping. It's the fun part. How do you find homes? We recommend using an app called HomeSnap. All the realtors use it. It's directly connected to the MLS. There's a lot of other apps that I'm sure you've heard of to search for properties. They're not quite as accurate as HomeSnap. HomeSnap is the best one. If you have an agent, ask your agent to send you a link to their version, and you'll get even more information. So HomeSnap is a great, simple app, best way to search for properties. I guess hot areas, like any agent, anyone on there, like what are some areas you're hearing are hot that are great investments that are up and coming right now? Any quick comments on that?
I'm a long-term advocate for South LA. I personally built a lot of personal wealth by getting lucky. Before I was in the business, I bought a house for $400,000 in 2013. It just appraised for well over $1 million. There's still, although a lot of South LA, Leimert Park, where I bought, a lot of that appreciation has already happened. But there are pockets and pockets in South LA that are being developed, and that are being turned over. A lot of these old houses that are, older people are moving out and being bought by developers, and they're being gorgeously flipped. A lot of that happened during the pandemic. There's a ton coming on the market. And I just know, also being a long-term West Side resident, you get 100% more for your money. Like that, the place that would cost you $3 million on the West Side, you can get for 1.5 in Lemert, even in Lemert. And then as far as investment property, there are tons of pockets a little bit further into the neighborhood where deals are being made and old craftsmen's are being restored. Anyway, I'd love to show you people sometime. It's amazing.
I personally like the Whittier area. It's actually a good location for first-time home buyer because the price is affordable, and I do see a great appreciation in Whittier as well. And then especially you can get some homes like it was the beginning of this year, mid 800s up in the hill, big lots. You know what the dream for $850,000. Yeah.
And you're near San Gabriel too. Someone mentioned
Yes.
in the chat. What do you think about that area?
That area is great, but it's actually what part of San Gabriel? It's actually big.
Mm-hmm.
Of course, some areas are really expensive. Of course, when you talk about nice school districts, San Marino, wow, super expensive. But we're, yeah, I will put in my contact information. Talk to me directly, so I'll show you some areas in San Gabriel that's more affordable. All right.
And Lori Pond is mentioning Eagle Rock. I still think like my two areas are, I think North Hollywood still has a lot of room for appreciation.
Agreed.
And then down in the South Bay, San Pedro, I think by the ocean, there's a lot of new development. The whole port's being redone in that area. Amazing restaurants coming in. I think that area is going to appreciate as well in the next few years. So, but it's all, you know, the area is the fun part, trying to figure that out. And we always recommend go there at night, go have dinner, go to the shopping areas and see, you know, how it feels to you. And be a little adventurous, try to explore a new area. The more areas we have to work with, the better opportunity you will have to find the actual house that you really want. If you're really restricted to one city, then the chance of getting that perfect house is going to be really, really tough.
And your buyer's agent can help you with that.
Yeah.
We can suggest areas you might not have thought of.
Briefly, I just wanted to say, considering buying a condo versus a home, you know, people say, oh, I don't want to buy a condo because there's an HOA payment. Don't let that stress you out. A lot of that money in the HOA payment is going towards insurance that you know, are not paying towards. So you're, like Marty said, your insurance rates are going to be less. Plus, it's like another savings account that's going to help maintain the building. So you're paying a few $100s a month that eventually your building's going to need a new roof or new plumbing. All of that money that's in the HOA and in the reserves, a lot of times that will be enough to fix whatever problems the building has. When you have a home, if your roof starts leaking, it's all on you. If you have a sewer line issue, it's all on you. So there's pluses and minuses. It's kind of a little bit of a wash. You have obviously more privacy in a home, less privacy in a condo, but less to maintain in a condo. So don't rule out condos. You know, consider it. And if you have questions on that, we can help kind of walk you through that whole process. Okay, so Cindy, we found the great house.
Mhm.
Now, there's going to be 4 offers in it. What do we do?
14.
Oh,
Yes.
no, 14.
Yes. Yeah, so I've been seeing a lot of double-digit offers, not just 4 offers, you know, lately.
And
So-
Cindy has had a great success rate of getting them accepted. So don't let the 14 scare you.
Yeah, besides the price and terms, we also need to focus on the emotional side of the transaction. So don't forget to create a very memorable and sincere first impression at the open house. If they have an open house, to the listing agents, you know, or the seller, make sure they remember who you are. Make sure that you're serious about buying a home. So I always introduce my buyer, you know, at the open house. Like, this is Anthony, this is Tim, this is so-and-so. Make sure they remember your names, a little bit of stories about you, why you picked this home, why this home fits your needs. This is very important because we cannot use a love letter nowadays. We used to send love letters together with our offer, and now it's strongly discouraged. So that's one thing. And understand the seller's motivation. Why are they selling the home? Every seller has their own story. So it could be they just want to move closer back to their children, or they just got a job relocation. So why are they selling the home? So it's our job, Tim and I, you know, actually need to have a lot of conversation with the listing agent to find out why. That why can actually help you win the offer. For instance, like currently we're in escrow, the seller wants to go to Hawaii. So is lease back part of the deal? Yes, it is. So I told my buyer, to offer a free lease back to the seller so that, you know, she can have a less stressful move to Hawaii. So this is one of the things. We are here to, unfortunately, we are here to solve the seller's problem because it's the seller's market. So we need to find out.
Yeah, no, it's solving the seller's problem. That's amazing. And it's not always about having the highest offer or
Yes.
having cash. That there's other things that are going on behind the scenes that are very important that your agent must understand. And a lot of times agents don't. So, you know, what Cindy's saying is really important. Yeah.
And besides that, you know, sometimes seller is buying a replacement property. So we, you know, as the buyer's agent, we need to find a way to, you know, work with the other side so that we can help them get their offer accepted. I'm talking about a seller's replacement property. So we have to work together. This happened to me a few times. You know, it's always important to have an agent who is very communicative, very transparent, and know your position really well. Of course, money is very important. Yeah, I know Anthony talks about cash. Yes, cash is king, but sometimes cash offers is not always the winner because they may not offer the best terms, or they may be a little cheap in not offering a good price. You never know. And the next thing I really want to talk about is understand your financial position and also be honest with us, with your buyer's agent. You know, we need to know how much money you have. What kind of financial terms are you thinking? Because we may need to come up with a strategy to help you win, to come up with a very competitive offer. So I talk about price, I talk about terms. What are the terms? It can be a short physical inspection contingency, or maybe no appraisal at all. So if you don't have a lot of money, of course, I'm not going to tell you, hey, waive your appraisal contingency. Let's try to be competitive. This will do you no good. So when it comes to appraisal contingency, I think Marty would be able to help you because everybody's offering like tens of thousands of dollars above asking. What happens if it doesn't appraise? So you have cash, wonderful. We'll pay the gap if you're willing to. If not, then Marty can actually do something called adjusted LTV, loan to value ratios. It depends. It's case by case.
So if you're putting 20% down,
Right.
put 15% down instead. And so there's ways to solve the appraisal issue. Yeah, if it comes up. And we don't see it come up too often, but if it does, yeah.
Yes, of course, we need to run a comms, and then you also need to have a good buyer's agent to work with the listing agent to prepare the comms to the appraiser. That happened to me a few weeks ago.
And yes, absolutely. Prime the appraiser to come in.
What is your strategy though to talk a little bit about the escalation clause?
Oh, escalation clause, that's the money part. Escalation clause is if you're in a strong financial position, if you're willing to play this bidding game, so you can actually offer X thousand above the highest and best offer. This is one of the strategies that I've been using very, often lately. You can do it with cap or without cap. You know, it depends on how strong your financial position is. I've been doing it without a cap, which means that I'm offering 5,000 over the highest and best without telling them that my cap is, let's say, $1 million. So when they come back with, hey, what is your buyer's maximum purchase price they can afford? It's like, you tell me. It helped me many times that we got into escrow because of this wonderful escalation clause.
Yeah. It's not as scary as it sounds either. It's like if for some reason the bidding goes so far out of your price range, we can get you out of the deal.
Yeah, we just walk.
You just walk away. So it's interesting. You don't have to just offer $1 million. You could say we're going to offer 5,000 over the best offer, which is an interesting strategy.
Yeah.
And so in this market, Marty, I guess for you, I'm sure some people here is like, well, am I overpaying for this property? Am I going to be paying too much? How does that come in with you in the appraisal?
So yeah, the appraisal is an integral part of the whole process because we are making sure that we're watching out for you, but in turn, we're watching out for ourselves as well too, because we want to make sure that you're not overpaying for a property. So if the appraisal comes in, whatever the value is, we do not only is the appraisals work, the appraiser comes in with the value, but we also double, triple check the appraiser's work as well to make sure that the appraiser has not missed anything. We have a lot of tools on our end that we check for. So yeah, we're making sure the valuation of the property is properly valued because we're not gonna let you overpay for something that we feel like might be valued lower. So we're basically protecting you, but we're also protecting ourselves.
Yeah. So there's typically a contingency in your offer that says if it doesn't appraise, we can back out. So that's that's what Marty's talking about. Cindy was talking about something a little bit more complicated going over, but it's also a great strategy too. So it varies case by case, buyer to buyer, but just know there's ways around it that we have as a team with Marty, with Cindy, that will help you to get that property and make it happen and keep you protected at the same time. So awesome. Once you get that offer accepted, hallelujah. What the seller will require at that point is a 3% initial deposit. So you need to wire 3% of your purchase price into escrow as a good faith deposit. And it sits there until the very end, and it'll go towards a credit towards your down payment or closing costs. Or if you're a doctor and you're lucky and you're like, I don't have a down payment, you'll get that money back minus your closing costs at the end. But it just sits in there for to show good faith. Once that's there, the next and most important thing that happens that realtors are really going to guide you through is the inspection process. So, you know, what are some of the most common inspections that you guys would recommend a buyer do, and how much does it cost? Like, what are some of those inspections you want to find out?
I always ask my buyer to do a general home inspection.
Always.
You know, I don't.
For a condo, for a home, always home.
It's not
general home.
expensive at all. You know, it depends on the size and the location of home. It can range from like $250 to like, you know, $450s. Unless you're talking about a mansion like size, then it will be thousands of dollars. You know, if a regular single family home is just maybe $450. I would also suggest like a sewer line inspection, the scoop for a single family home, because most of the homes in LA, they're not young. So the scoop is usually about $250.
And that could be a huge expense down the line if there's a problem with the sewer
They put
line.
a camera down the sewer line. So fun, and find out what's wrong with the sewer line. A lot of times there's cracks and roots. So we want to discover that.
Correct. And then a foundation is pretty common. As I said, the homes here are not young. So I would always suggest people to do a foundation check. It's also about $250 to $300. Yes.
So termite used to be part of our contract. It's not anymore. Do you recommend termite inspections?
I mean, it depends. In the current escrow that we're working on, they had tented the house 5 years ago. But the thing that was interesting about this escrow is we kind of came in after another escrow found out. So we had all of their inspection reports, but yet we still did our own. I don't trust somebody else's inspection.
Yeah.
And it was money well spent. And it turns out we did find some foundation issues, but then that goes back to the negotiation for credits and all that. And, you know, is this something that you really can't live with? So this is another thing the buyer's agent will help you with. You get this inspection report with like hundreds of items on it, and it's like, what do I ask for? Because, you know, you don't ask for everything, and it's different depending on the market. In this seller's market, you're less likely to get a credit.
Yeah, so you know, we're here to guide you to figure out what exactly you should be inspecting, because we don't want you to be surprised a year down the road and have a roof leak or have your sewer line back up. We want to make sure that you understand what to inspect so you know the condition of the house. And then at that point, you can decide, you know what, this house has a few issues, but I'm okay with that. Or this house has a few issues and I'm not okay with that. Let's get out.
Yes.
And before you get out, you know, there is an opportunity to negotiate. So maybe we are able to reduce the property's price. It happens all the time. Maybe we can get a credit. Maybe the seller's willing to repair some things. All of these things depend on the market, the price we offered, what the repairs are, and the situation. And that's where your agent really will come into saving you and protecting you the most, as far as negotiating that process and helping you decide, is this okay to move forward or not?
And going back to my original point about going to a listing agent, you're not going to get any of this if you go to the listing agent, because the listing agent is going to do what the seller wants.
Yeah, it's a little trickier.
When it comes to selecting a buyer's agent, make sure your buyer's agent is very transparent, honest, and is really have your back.
And available. That's why we work as a team too. Yes.
People don't like to pick up the phone.
No, that's why we weren't like to work, because there's two of us. So that somebody's always going to be there at Saturday night at 11 o'clock when you panic because, you know, you get some strange email from in the middle of the transaction and you don't know what it is.
Buying a home can be very overwhelming, right? That's why we're here. That's why Marty's here. We're here to help you get on that path step by step to protect you as you're going through this process. I mean, any other questions that come up, please let us know. We're going to stay on this Zoom for a little bit while to answer any of that. But I just wanted to thank Marty, Cindy, Tim, Yale, for participating today, and all of you guys for joining. This is recorded and it will be on our YouTube page tomorrow. So you can search The Collective Realty on YouTube. Also, our website has so many great tools. So please, please, please see that. And with that, I want to thank you, and hopefully we'll see you at our next seminar and hang out a little while and ask questions, but I'm going to stop the recording. Have a good day. Where's the record? Oh, here we go.
Recording is up there.
Okay.
Yes, stop recording.